great question. I'm going to kind of answer this backwards to kind of explain the first one by using the second one. Okay, this flexible premium structure is based off of the contribution limits for your policy. These are referred to as the guidelines, and they are calculated by the IRS for every single individual policy. Now, these are based off of your age, your health, your gender, what you're contributing, what your death benefit amount is, what your death benefit type is. All of these factors affect these numbers, and it's a minimum and maximums, and there's different time periods, which is again why it's so important to have an agent that understands these products, and a lot of it has to do with these guidelines. Now, here's the thing. The guidelines, let's say your maximum is $6,000 and your minimum is $1,000. We're just going to do easy math. If you do $200 a month, that's $2,400 a year, okay? Underneath this is basically fees and stuff. You don't want to be hanging out down here. You want to be closer to that $6,000 because any of the money that's left over between those and the maximum is going into your account, and that's what earns the uninterrupted compounding interest, okay? So the $200 a month is less than the recommended 10 times your age, which that recommendation came about because as you get older, the cost of insurance gets more expensive, and that's just the way life insurance works. There's nothing we can do about that. So to get you a cash value at the end of the first year, we highly recommend your minimum starting point being 10 times your age. Now, if you want and definitely know that you can put more money in each month and kind of fill that space back up so that you have all that money earning interest, that's great. But if you truly can only do $200 a month, it's not going to work as well. And that's where things get a little bit iffy. We really want this to work for you and not you working for it. And so if you have the extra, great, it should work out great. $200 a month, it can work. It just takes everything a lot longer to grow because you have to spend so much time paying off the initial fees. As a general rule of thumb, fees are 1 to 2% of the death benefit amount, which is again why it's so important to have the minimum death benefit for your contributions, because we want to keep those fees as low as we can possibly make them. But $200 a month for someone who's almost 40 is about half of what you should be doing. I hope that helps. I hope that answers the question. And obviously, if you guys have more questions, you know what to do.